Welcome to the Become Sensible podcast, where we discuss practical accounting, finance, and tax for everyday business. I'm your host, Fiona, and I'm here to show you that no matter what your business financial situation is, you can change it. Good morning, my business bestie. Thank you so much for tuning in to Become Sensible. So today, let's talk about the world of financial report, where this is the key to unlock your business financial successful. Normally, when we talk about financial report, there are three financial reports. First is income statement, which is profit and loss, or we call it P&L too. The second is balance sheet, and the last one will be the cash flow statement. To talk all of this information at one time for three financial reports, that is a lot of information. So it's hard for you to digest. So I just break it out into three episodes. And today we will dive in deeply into the income statement. And let's talk about how to understand it, the basic of it. So the structure of our conversation, it will be how an income statement of profits and loss of P&L look like. The second part will be what you need to pay attention and how to understand a little bit better your profit and loss. Because most of the time, as a business owner, as a CEO, as the founder, you has less likely to be like the person who actually prepare the financial report of profit and loss, except the accountant like us, we need to take care of those things. I receive a question all the time from the business owner is, I don't know what type of these bunch of number on the profit and loss. It's like a different language. And so what we can do to actually understand it. Today we will talk some basic way that have you to look at the number in the better way. First of all, what is an income statement? And we can say that is profit and loss. We can say that is the P&L. So basically, an income statement is the snapshot of the company transaction over the period of time. For example, we say the profit and loss for April. This is all the transaction happening in your business in that period of April. And normally, a typical profit and loss, it will start with the revenue on the top. And so depends on each way of people report it. But I advise to have a very detail of what type of service that you sell, what type of product that you sell. You have a revenue line for each of these, like product A or service A, product B, service B, revenue by each line, because it's help you to look at the amount that you sell for each product and service. So sum total all of these sale is called total revenue, and that's a total of the product and service that you sold for that period. Underneath of total revenue will be cost of goods sold. What actually cost of goods sold? Cost of goods sold is the direct costs that go to produce and deliver a product and service. Like for example, the cost of direct labor, the people that who actually manufacture, create the product for you, or like the material costs that go directly into the product and service. And then like even some shipping costs that to get the product to deliver to your customer, it can be counted into the direct costs. So when you add all of these together, you have a total cost of goods sold. And if you get the total revenue minus the total cost of goods sold, will be gross profit. That is the profits after you minus all the direct costs. And then after the gross profits will be operating expense. Operating expense, basically the expense for your business to operate and maintain the business. And operating expense can be a fixed cost or a variable cost. Depends on how you structure it. But that can be like very complicated and complex thing to discuss. So we can say the basic thing. Operating expense including like the sale, the marketing, the administrative costs, the rent, utility, all of these regular costs that help you to maintain the business. When you total all these operating expense, total together, it will be total operating expense. And you get the total gross profits minus total operating expense. It will be the profits from operating expense. And then after that, you will have a tax expense. And then you also have a other income and expense, such as the income from dividend, from capital gain, from interest income. After all of these together, you arrive is called the pre-tax income. And after you minus the tax, it will be the income after tax. And then that will be your net income. This is called the bottom line of your business. So again, it's revenue minus cost of goods sold minus operating expense at any income and expense from other activity that not related to operating. Then you minus the income tax. You will have the net income. So that is the basic of your profit and loss or your P&L. So to really understand, now we talk about the back to that, to really understand how your profit and loss is saying anything for you about your business. So one of the ways that number one, I always advise my client, and actually we on our financial report to client, we do is the percentage of the total revenue. It means like all of the live revenue will be divided by total revenue to know exactly what is the percentage that is contribute for the total revenue. And then all of the expense line will divide the total revenue. That helps us to understand how much is the percentage of each expense compared to the total revenue. And why it's so important? Because if you tell me that, okay, your cost of goods sold is $30,000, and I wouldn't know what that $30,000 mean at all. But you tell me, you give me your financial report, your profit and loss, and see total revenue is $60,000. Your direct cost, your cost of goods sold is $30,000. Then I know that is your 50% of your revenue go to cost of goods sold. That is every $1 revenue that you sell, 50% of it go to manufacture or create that service or product. Then 50% is what it left. Then if you say you spend $10,000 into the marketing, I wouldn't know what does that actually mean. First of all, it needs to be in the context of your industry, but it also very important in the context of your revenue. If you make $60,000 in revenue, or $50,000 in revenue, and you have a $10,000 is the marketing cost, which is that 20% of your revenue go to marketing. That is so much easier for you to see, like whether that actually generate for you enough the revenue. Is this efficient way to spend the money? And then you compare that $10,000 in marketing 20% with another 40% of your payroll costs for people to actually operate your business. That make up 60% of your business is spent. Then for direct costs and everything else, create a very small percentage, for example, of net profit percentage. Then we know, okay, this is where the number compare percentage with percentage. It's easy to make the comparison and understand how it look like in total financial picture of your business. I mean, like we don't know exactly what percentage is good. It very depends on the industry that you perform. There's so many industry that it will cost basically like 50% of their revenue need to be go to direct costs. And then the rest of it need to work in that 50%. So it depends on your industry. But if your numbers is odd compared to the industry is one thing. The second thing is if the percentage is oddly high compared to other expense, we need to ask the question why and what actually happened and how we can actually improve that number. So it makes sense when you actually look at it as the percentage of your revenue. And number two is look at your operating expense and need to double check on it. Because one of the things I see a lot of business owners face the challenge is their operating expense growing in the rate faster than their revenue grow. Of course, we optimistic people. We always say, okay, we always can make more money, we can sell more, we can bring more revenue. But if your operating expense is growing in the faster pace than your revenue, and it's a huge percentage, a chunk in terms of your revenue, it will take out all of your cash. And when we face the challenge in terms of cash flow, once you face the challenge in terms of cash flow, it's very challenging to turn around that situation. So make sure that you watch out your operating expense. And you always, again, ask why. Why you spend that money? Why you have that legal fee so high? Why your software and technologies expense is so high? Why and what actually happened and how you can make it better? Because I know one of the things is in this technologies world, that so many new tools and new systems that coming out like very often. We can buy a bunch of them and we actually don't make use of it. All of these tools actually don't talk together that create the inefficiency in our business. So watch your operating expense and don't let it grow in the faster pace than your revenue grow. Finally, many people will say why you have a loss. A loss in the business, there's so many reasons, but there are a couple of things that I can think of and potential costs, but we just talk about generalized here. We're not like talk a very specific for its income statement unless you give me your income statement and financial report. So first thing is the pricing problem. One of the many common pricing mistakes that many business owners make is when they price the product or service, they forgot to allocate some of their operating expense into the cost of make that product or service. And some of the business that their operating expense is not 50% of the revenue at all. Some of them 60%, some of them 70%. And if you forget to allocating this expense to the product and service pricing, on every unit or service that you sold, you don't make any profit on it at all. The other thing is if you sell a huge quantity of the volume of the transaction, what it helps you is it cover your fixed expense, your operating expense, and you make the break even and you start make the profit after that. But there's so many challenges these days for many people to actually bypass that break-even. They cannot go over the break-even point first because their operating expense is so high and they forget to allocate it into their price. The next one is excessive operating expense. And of course, I don't mean like every accountant or CPA or fractional CFO saying that, oh, you need to cut costs. But most of us, one of the things that we need to consider is at the start of this person that's scaling the business, a lean startup, a lean operating team, the lean financial operating is very important because it helps you to not demands a lot in terms of cash and funding, and not everyone have enough cash and funding to operating at all. So make sure that the operating expense keep in check. The number 3 reason is the inefficiency in your business. Maybe you have a ton of different systems and they didn't talk together, and it takes your people like go to this system to do this, go to the other system to do the other thing, or it takes so much time for them like to actually get an email coming out or like to send anything out to the markets. And one of the things in this economy, the challenge of the speed to the markets, your sales cycle, and this will determine whether or not you actually success in terms of the business financial. So to make sure that the efficiency is doing very well in your business, it doesn't take people forever the time to actually launch the product or to actually like click and buy your product actually for your team to perform more work. So make sure that it's need to have a efficiency in your business. So to sum it up, here are the 3 takeaways from your profit and loss. Number 1, look at your number at the percentage of your total revenue. Number 2, manage your operating expense wisely. It needs to go in the rate that you grow your business. It cannot outpace the rate for a very long time. Because of that, it will create a congestion in terms of cost and funding. And of course, we always can borrow money, always get funding and debt and all of these things. But thus, it creates the financial stress and also some certain operation and cash flow cycle that you don't want to go in, because the time for you to undo that cycle is take you time to go out of that cycle. Number 3, understands your business might be the reason why it has some loss, or the why the number is in the way that it looks like. So thank you so much for your time, and I hope it's helpful for you. And tuning into the next couple episodes to learn more about your financial report and how it affects your business decision.